Well, if you look at where we were, a year ago, everybody was raising capex and they were getting rewarded for raising capex almost
Yep.
across the board. And I think that that's obviously changed dramatically. I think you saw in the results this week that where you start to see that acceleration in growth, which you saw for Microsoft and Amazon versus where you have issues like you saw with Meta. Apple's got different issues because I think that's much more about the supply chain and the fact that memory prices are so high, but I don't think it's a demand problem. So for something like Apple, I would be less concerned about that in the near term, but longer term or medium term. But I think that it really shows you're starting to get bifurcation on how people are accepting the kind of spending that's happening and what people hope for on the return side.
So this is definitely the earnings season where AI spending stopped being enough on its own. But we're seeing companies spend billions and billions on AI infrastructure. Are there key signs that you're looking at to see whether those investments will actually pay off? That might be a tricky question, but I know you look at these closely.
Well, I think that this was where the earnings were very important, because had you not seen the acceleration in demand that Microsoft was talking about and that AWS was talking about on that side, I think that that question would be even more in focus. But I think the fact that also you've seen a little bit of moderation on that raise of CapEx. Yes, the CapEx is still strong, but we're not talking about doubling it again and again and again. And I think that that's important. And I also think that, the issue with what's going on in China and some of those models that are cheaper, that also brings into question, okay, maybe the CapEx moderates a little bit. And I think the market starts to reward that moderation to some degree, because it's not just you have to get there first. It's how do we integrate this? What's actually going to happen and what are you going to get paid for?
Overall, what's your take so far of earnings? Because, boy, we had a really high bar to clear. I mean, we had fantastic earnings in the first quarter, pretty big expectations for Q2 as well.
I think that the earnings, you're still seeing earnings growth in the places where you expect to see it. In the information technology side, you're still also seeing it in industrials. What you're starting to see, like Tyson and like Procter & Gamble, is some real issues on the consumer side, because consumer staples are having trouble with that pricing. You're starting to hit a wall with pricing. You don't see that yet in the technology space, but this is why you saw such volatility, is that adding China with a cheaper potential mix into there makes it question how much you can continue to raise price on the technology side. I think that's going to be the tension going into 2027. I can't believe I'm saying that we're going into 2027, but there you are. And I think that that's how people are going to be looking at things: am I seeing that acceleration in demand, and can I count on some returns from all that spending that I'm doing right now?
We are heading into 2027, and it's August, which is for me hard to believe. What about the Fed? They're balancing stubborn inflation against concerns about consumer pressure. Do you think there's a risk that maybe keeping rates higher for longer may create more economic damage than maybe some brief relief?
I think the problem is that where we're seeing the inflation coming from, it's hard to see how higher rates are going to solve that problem. If you've got a supply shock on oil, it's hard to see how higher rates help you unless you just kill demand. And that has ancillary effects that they don't necessarily want. So I think it's more about keeping things elevated as opposed to elevating them further, although that argument is going to continue into the summer. And we'll see what happens both with the employment report and what happens with inflation, because that oil shock that was getting better it's now gotten worse. I mean, today you're down $4.5. There's a lot more volatility there, and I think people were expecting a one-way trip down, and I think that's going to complicate things for the Fed.
Once again, 2026 is shaping up to be a year driven by information technology, consumer communication services. Are there areas outside of there that maybe investors should be looking for, whether it's financials, healthcare? I'm not sure.
Absolutely. I think that there are places in healthcare. I think that there are places in industrials. This is really a good time. I mean, you saw what happened with the memory stocks, and you see what happens with the hardware stocks occasionally on this AI trade. You want to be looking at the companies that are outside that to some degree and have a good cash flow, a good balance sheet. We're big believers in capital return. We want to see those dividends being paid. We want to see that cash flow coming through and that cash flow growing. And I think that this is a good time to be looking in those areas, because some of the valuations are not as punchy as you see on the AI hardware trade.
Well, some of those tech names that we've, since the beginning of time, whether it's Google or somebody else, gobs of free cash flow. Gobs is a CFA term. Gobs of free cash flow. Now they were cash flow negative in some of these. I mean, that's a real issue for investors to deal with.
And I think that that's exactly why that CapEx question is becoming a bigger and louder one, which is, okay, if you're funding it out of cash flow, at least you're funding yourself. If you're now going to the debt markets or going to the equity markets, you really have to justify that in a way that when you had gobs of cash, again, a CFA term, on your balance sheet, people didn't question that so much. And I think that those questions are getting louder.